Good morning, ladies and gentlemen. Thank you for joining us today. My name is Simon Wang. I'm the Managing Director of China for Logistics and Industry Park. My colleague Luke Li, he is the Managing Director of New Economy, and Rui Hua is the Managing Director of Hong Kong. Today's presentation will be carried by three of us. So let's take an overview of the Great China market. ESR Group has been deeply cultivating in China market for many years, and we have achieved great accomplishments. As of December 2022, our asset under management has reached $12 billion with a GFA of 12 million square meters. There are 136 quality assets that are strategically located in 37 dynamic cities, as shown in the map in the blue color. Now let's take a look at the China operating performance for 2022. For investment segment, ESR portfolio remained resilient with 90% of occupancy, which is above the market average. The new leasing approximately is 1.4 million square meters with a high reversion of 6.7%. And turning into fund management segment, 1 billion fund was raised last year, focused on new economy. Dry powder for deployment is $1.8 billion, and capital deployed in last year is 0.9 billion. The total asset under management has grown 22% to $12 billion in last year. Fund AUM has rose to 9.6 billion by 41% from the previous year. AUM growth is largely attributable to a strong fundraising and a group market leadership position in the new economy. We are poised to gain the market share through our portfolio, fundraising platform, and new economy development. High quality of asset, fund, and development focus on new economy real estate enable us to build a strong operational foundation in China. And high occupancy and positive capital growth evidence the resilience and potential growth of our AUM in China.
I believe many of you haven't been traveled to China since COVID. So let me give an update on the macro before we discuss about our business and strategy. The keywords for the China economy in 2023 can be described as triple Rs. That is reopening, rebounding, and returning of China to the global stage. As you know, our government implemented a very strict COVID control policy over the past 3 years. Then in December last year, the government took a U-turn and ended the zero COVID policy. By February this year, most people in China have gone through their COVID journey, and the normalization of life and work has been equally fast after that. If we look at some of the economic and mobility indicators, such as domestic flight, metro traffic, and hotel occupancy, most of them have actually been back to or even exceeded the pre-COVID level. The photos on the left were taken during the recent Golden Week, and we can see that the crowd is back. And starting from March, international travel has also resumed, currently at 40% of pre-COVID level, but will increase over the next few months. And we are seeing many foreign political and business leaders back to China since April. 2023 will be a year of recovery, and we are already seeing more green shoots, even though the data may show up more obviously over the next few quarters. However, the recovery will be more driven by domestic demand, and our government has set a modest GDP growth target of 5% this year. The new government, led by the new Premier Li Qiang, is more pragmatic, pro-business, and pro-foreign investment, which helps to restore confidence in the private sector and among foreign investors. I believe many people were encouraged by the news of the return of Alibaba's founder Jack Ma to China 2 months ago. So the overall policy tone and priority for this year is to ensure stable recovery. And the disruptive policy campaign towards the tech sectors and the residential developers over the past few years have also been dialed back since the beginning of the year. On the geopolitical front, even though the risk is still there, but the level of tension has lowered compared to last year. And we notice that the rhetoric has changed from decoupling to de-risking. The residential sector is still in the middle of soft recovery in China, but by and large, the housing sector's role in supporting China's economic growth will diminish on a going forward basis. On the other hand, the government has been pushing for more investment into infrastructure, hard tech, healthcare, and decarbonization, with an emphasis on technology self-reliance and self-sufficiency. And this will benefit many of the new economy real estate sectors that ESR is in. And lastly, the China Central Bank has been lowering interest rates to support growth. Today, China's 10-year government bond is at about 2.8%. And for a first time in a long period, we are seeing positive yield spread for many of the real estate asset class in China, which helps to attract more investors.
So similar to the economic situation, the logistics market is expected to recover in 2023. Major indexes, including the PMI, CWIs, and LPIs, all rebounded in 2023, indicating a strong recovery in manufacturing and logistics sectors. Supply of logistics space in Tier 1 city will peak in 2023 and decrease afterwards, while the demand is expected to rebound by 30%, driven by the recovery of domestic consumptions. We do expect the vacancy to rise for our portfolio during the first half year of 2023, and then getting a tighter beginning in the second half of the year. According to CBRE, the logistics cap rate of Tier 1 city is projected to compress further due to the resilient leasing market and strong capital flow. In terms of capital partners, ESR China has been established strategic partnership with a group of global and domestic institutional investors. A number of them has invested ESR on multiple funds all across multiple countries. Some investors, such as APG and PGGM, have worked with us since the early stage of ESR. In terms of customers, ESR works with leading organizations across multiple industries. Some well-known companies such as JD.com, Alibaba, Daimler, JDS, and of course, Thermo Fisher are all the key customers of ESR China. The strategic partnership with our investors and customers provide ESR with a valuable insight of the market and back ESR's fast expansion. We are dedicated to maintain the cooperation and extend it to a wider range of investors and customers. We will continue to deliver the best class in service to our customers and share the future growth with our investors.
Our business in China has become a broader-based new economy real estate platform with a focus on the below key areas. And firstly, logistics is still our bedrock of the business. In addition to active asset management, especially on the leasing front, as Simon mentioned, we are going to set up a core fund to explore income portfolio acquisition opportunities. Also, we are actively pursuing logistic urban renewal opportunities in Tier 1 cities, redeveloping old single-story warehouse into new multiple-story ones in cities like Shanghai. We are also actively expanding into other adjacencies besides logistics, such as high-end manufacturing, industrial, and life science real estate, which we expect to make some breakthrough this year with some promising pipelines and also positive feedback from our capital partners. For the other sectors, data center in China will see a rebounding demand in the second half as the government policy have become more friendly towards the sector and also partially driven by the rise of AIGC, including many local versions of ChatGPTs, and they will all need data center to support that growth. And lastly, for solar, we will complete about 100 megawatt capacity by end of the year, and we have started a discussion on a solar fund. Also, the rapid development of energy storage technology will greatly increase the investment universe of renewable energy in China. On fundraising front, these are the 4 key initiatives this year. We will continue to recycle capital from balance sheet assets to replace our own capital with fee-earning LP capital and redeploy into attractive development opportunities. The discussion is ongoing with some domestic insurance companies. On C-REITs, as already announced, ESR will launch our own C-REITs this year which will allow us to tap on the very deep pool of domestic public investors. The PN15 application was already approved by Hong Kong Stock Exchange and is currently under review in Beijing. My colleague Rui Hua will answer more on series later if there are questions. And interestingly, the development of C-REITs have attracted more capital to invest in private funds, which targets C-REITs listing as exit. We call this pre-REITs fund in China, and we are exploring this new fund product with domestic capital partners. And lastly, for life science real estate and high-end manufacturing industry, we are discussing with some sovereign wealth funds and domestic insurers with the target to set up both funds within the year. These are our key priorities for China this year. We have already mentioned C-REITs and capital recycling. On the investment front, this year is actually a very good window for land acquisition, as the government who control land sales in China is very eager to grow the economy. But we will be very selective and only acquire sites in more defensive markets. The new development activity will generate good development profit and support our continued AUM expansion. Meanwhile, we are very focused on leasing and are proactively expanding our tenant base to include more customers along the manufacturing supply chain. Next, we will show 2 case studies on the new strategies as mentioned by our co-CEOs, that is life science real estate and high-end manufacturing. Life science real estate is one of the most preferred sector in China by investors this year, as shown in many investment sentiment surveys by JLL and CBRE. And China has emerged as an important player in the global life science value chain in recent years, especially in the area of innovative drugs and contract research. The demand for life science space is strong in China, while there is an undersupply of such property due to limited stock and very high entry barrier. This is mainly due to the very strict environmental impact control by the government. ESR has set up a very capable life science real estate team and have secured a few high-quality projects over the past 12 months. In terms of investment location, our focus is key life science clusters in first-tier cities, such as this area in Shanghai, as shown on the graph on the left. The assets on the right is our first project acquired last year in this sector. It is located in Zhangjiang Sun City in Shanghai, which is basically China's equivalent of Kendall Square when it comes to life science. The tenants in these projects are mostly local biotech companies focusing on the R&D of innovative drugs. And through the acquisition and management of this project, we have established good relationship and a network with local biotech firms. This framework gives an overview of why life science real estate is attractive in China. We won't be going into details. In summary, it is an investment case characterized by rising demand and the limited supply with very high entry barrier.
So this is a second case study of an interesting project that under our operation in China. The project is called Suzhou ESR Advanced Manufacturing Industry Park, which attract global companies to locate their R&D labs, manufacturing plants, and warehouses together within one park. It is expected that the registered capital will exceed $100 million in this park, and the annual output value will exceed $800 million, and the annual tax payment will exceed $50 million. All the leases in here are long tenure with built-in escalations, backed with a strong credit profile of those MNC tenants, which provide a stable inflation hedged cash flow. The park has received 2021 Suzhou Foreign Invested Company Award for outstanding performance of stable growth. And it is worth to mention that all the building in this park is all certified with LEED Gold certificate. Take some example of the tenant here. Thermo Fisher, the world's top scientific instrument company, has leased 50,000 square meters for 10 years. It established its largest life science industry park in Asia Pacific region and already invested 50 million capex on facilities and renovations. This reflects its optimism about the growth opportunity in China. On the other hand, LabCorp, the world's largest CRO company that produces clinical trial accessory products, has also leased 5,000 square meters for 10 years. Those global leading healthcare companies established a major facility in China to tap into the region's strong growth potential in biopharmaceutical and clinical research. Their multi-million-dollar investment in new industry park and production bases underscore the China's rising prominence in global life science, as well as its appeal to international healthcare cooperations. So after the case study, let's look at some figures to explore our rationale behind our strategies. The R&D expenditure in manufacturing sectors has been accelerated in the past decade. Industries such like transportations, instrument, pharmaceuticals have seen a significant increase in R&D intensity. The new 5-year plan from the central government encourages sustainable industry facility to support green development. Eco-friendly company will have the competitive advantage over the peers in the marketplace. Independent innovation in high-tech sector like semiconductors, AIs, and pharmaceuticals will drive a sustained demand in future. Localization of supply chain for high-tech industry is likely to increase. National strategy of Made in China 2025 will lead a capital and policy to support advanced manufacturing sectors. Property that better catering to the need of these emerging sectors will catch incremental market demand. And this slide shows the FDI situation in China for last year. There was 1.23 trillion FDIs invested in China, growing by 6.3%. Let's look at the first pie chart on the left. Auto parts are the major investment field for foreign companies, which has occupied 32% of the total FDIs. High-tech manufacturing has attracted 26% of the total FDIs, followed by the energy and chemical sector and the pharmaceutical sectors. If you look at the second chart in the middle, from the investment destination perspective, 78% of the FDI is invested in Eastern China, and 57% of the FDI is invested in Jiangsu province, which is the main battlefield of ESR. We have acquired more than 5 parcels of land in Jiangsu province this year, and with a total GFA of 680,000 square meters under construction. From the fourth chart on the left bottom corner, it is clear that almost half of the FDI is attributable to the leasing of the property from a manufacturing industry. It creates a sustained huge demand for high-standard logistics and industry facilities. As a global leading logistics and industry developer, ESR is capable and dedicated to catch such emerging market. I'll pass to Ruihua, who will talk about the Hong Kong region. Ruihua, please.
Thanks, Simon. Happy to see many familiar faces this morning. I'd like to give an overview of the Hong Kong region, in particular the market outlook and the cap rate trends. Hong Kong is considered a matured market, and there are few industrial areas in Hong Kong, with the Kwai Chung area as the most prime. In the next few years, with the Northern Metropolis project, we're likely to see a new supply of industrial land, especially in Tuen Mun and Yuen Long, whereby the location is very near Shenzhen, China. Much of the existing industrial outlook in the market are basically old buildings, at least 20 years old, and they are not very ESG compliant. Therefore, there is a huge opportunity in redeveloping brownfield projects into modern logistics or through acquiring new government land. With the increase in e-commerce penetration in Hong Kong, especially during COVID, reopening of borders with China, controlled supply of new industrial land by the government, we are expecting the demand of industrial warehousing to remain positive and overall rent to increase at least 2% year-on-year. As such, cap rates are expected to stay around a range of 3.25% to about 3.8%, averaging around 3.6%. Next, I would like to share with everyone our overall strategy for the Hong Kong region going forward. For logistics or any new economy assets, we're looking to build ESG compliant assets by redeveloping up some of the old and existing stock. At the same time, Hong Kong is well positioned to take advantage of the development of the Northern Metropolis project, which links Hong Kong to the Greater Bay Area of China. According to the plan, there are currently some logistic land that's being earmarked by the government. We also see opportunities, particularly in the building of cold storage logistic assets in Hong Kong, mainly due to the lack of new modern supply in the market for the short and medium term. Currently, en bloc stock is only approximately about 3 million square feet for the entire Hong Kong market, and it's expected that about 600,000 square feet of old stock will be removed from the market every year starting from this year. As such, ESR will be commencing our development of the new cold storage logistic project in 3rd Q 2023, which I will elaborate more in the next slide. Lastly, with the redevelopment opportunities, we look for opportunities to convert suitable old industrial buildings or logistic assets into higher value assets such as data centers. With an estimated of $1.6 billion in gross development value, the Kwai Chung Cold Storage Logistic Project is the single largest logistic project in the entire ESR portfolio. It will also be the first purpose-built en bloc modern cold storage in Hong Kong since 25 years. With a GFA of about 1.5 million square feet, or about 140,000 square meters, it is one of the major logistic assets in Kwai Chung. The intention is to also make this the first ESG-compliant cold storage logistic asset in Hong Kong, as we are planning to apply for at least LEED Gold or Hong Kong Platinum Beam Plus. We're also collaborating with the China Light and Power, CLP, to provide the largest EV charger for the entire Kwai Chung region within the premises. With this project, ESR partners Hong Kong well-known developer China Chem Group, which ESR sold down about 49% stake to this group. It is also the first time that CCG participated in a logistic project in Hong Kong, and it demonstrates their trust in ESR's capabilities. As this is a new government land, we have an entirely new 50-year lease, which is the longest in the entire Hong Kong and expires in 2072. Since winning the land last year, we have already been able to increase the height limit by 8 meters to 48 meters in total without any additional land premium. And this is advantageous because it increases each floor's floor-to-floor height. Piling is also scheduled to start in 3rd Q 2023, and the entire project is expected to complete by 2027. Next, I would like to touch on the ESR Kwai Chung Data Center project, which is the first brownfield project in Hong Kong with a 132 kV transformer placed into an existing property. As we are not planning to tear down the building, this building is very ESG compliant, giving the amount of concrete that's safe, and we are also including other ESG features. As this data center is one that's embodied many of the ESG factors, we are actually looking to work with banks and CLP to issue the first sustainability-linked loan for a data center in Hong Kong. We have also obtained electricity from CLP, and upon completion, it will be the only asset with new electricity supply in the entire Kwai Chung region in 2026. Last week, we have also signed a lease with one of the renowned player, GDS, as our operating partner for 20 years. I would like to summarize some of the key takeaways for the Hong Kong region. In terms of demand, Hong Kong logistics, data center, and new economy sector remains healthy going forward. Location-wise, very concentrated in key areas like Kwai Chung, Tsuen Wan, and Tsing Yi. Coming from a low base for e-commerce penetration and reopening of the borders post-COVID, demand for good quality logistic assets remains strong. In terms of supply, new industrial land released by the government remains controlled and unlikely to see a big spike. Most of the near-term stock has already been pre-leased or reserved for self-use. Therefore, we are unlikely to see an oversupply in the industrial land in the market. For occupancy, it remains tight above 95%, especially in prime areas like Huaichong, Qinwan, and Qingyi. Fully ramped supply of logistic assets continue to be limited. Lastly, cap rates remain on an average around 3.6% as supply remains limited and good quality of industrial assets remain difficult to come by. We will see the narrowing of gap between logistics and office sector over the next few years. With this, I would like to end the Greater China presentation and open to the floor for any questions. Back to you, Marilyn, for the Q&A session. Thank you.
Yeah, thanks a lot, Rui Hua. Also, thanks to Simon and Luke. And thank you to the audience as well. I'm getting, a list of very quick questions, but unfortunately, we only have time for likely 3 questions, 2 for the gents and 1 for Rui Hua. Okay, so the first question for Simon and Luke would be, can you talk about the occupancy and rental outlook, given the e-commerce slowdown, slower than expected reopening, supply chain shifts out of China, and oversupply in certain markets?
Okay, I'll answer that question. I think for supply chain, for the logistics leasing demand, I think we expect a gradual pickup over the next few quarters. And as I mentioned earlier, our strategy is using to develop multifunctional facilities, not only to the logistic customers, also for the industry customers as well. We have received a certain requirement from the market that a lot of companies have their consolidation plans this year in order to increase their efficiencies and lower their cost. However, I think their decision will take a longer time to make because it's a big decision for them. So as most of our facilities located in the first tier and the 1.5 tier city in Shanghai and Jiangsu regions, so I think we'll take some advantages of that, and especially with the recovery of those domestic consumptions.
I will add on the supply chain shift. Yes, over the past few years, we have read some reports on some foreign companies set up factories in other Asian countries like Vietnam and India. Actually, we talked to many of our clients in China and try to understand their strategy. And we realized that it is actually not a zero-sum game. Some companies are adopting the so-called China plus one strategy in diversifying their production and supply chain by adding another facility in Asia, in addition to their massive facility in China. Yeah, but they are not closing down the China ones. Yeah. And also, today's China is simply just too large and too important to be replaced because it is very deeply integrated in the global supply chain already. Yeah. And lastly, ESR is also a market leader in these plus one markets. So you will hear from my colleagues later. So in fact, by investing in the company, it's a natural hedge against such diversification.
Okay, thank you, Luke and Simon. The second question I have for both of you would be, some other players have commented that it has become more difficult to acquire quality land in China for logistics operators as local government favor end users. And do we see the same trends?
Yes, that trend has been going on in China for many years, I think. So with the very limited land supply in Tier 1 city, I think it's very difficult for developers to get land in the first tier cities. However, I think I just mentioned in my PPT that we already acquired 5 pieces of parcel of land in Jiangsu, in Suzhou city, which is the very top and popular land for investment. I don't know how many land that our competitor have acquired, but those 5 pieces of land is all first-hand land that we acquired from the city, and we are very proud of that because our strategy is to benefit all the stakeholders that we invested in, and not only for the customers, but also for the local government, our investors. So in a way, I think I just mentioned in my PPT the second case study of Suzhou Park. The park itself generated a lot of taxes and generate a lot of output. So the local governments are also very happy to see the numbers and encourage us to build this multi-floored combination industry buildings that we can build. So similar to the situation to Japan, I think a lot of customers want to consolidate their production lines and also their logistics space into one park in order to maintain that stable of their business in China. So that's our strategy. Thank you.
Thank you.
That is also partially related to the oversupply concern you mentioned. I mean, it's true that government in first-tier cities are moving up their value chain when they want to attract investment, and we are pivoting our products in line with that strategy. Yeah, and also in first-tier cities, as we mentioned, in fact, a new way of generating supply is through urban renewal, logistic urban renewal. We are knocking down some of the very old one-story warehouse, which we already own, and we redevelop into multi-story ones. So in that way, you can also generate new supply. Yeah.
Okay.
Thank you very much, gentlemen. So just one last question, Rui Hua, for you so that you don't feel left out.
No problem.
Okay, can you please update us on the next steps required to launch the C-REIT? And also, touch a little bit on the timing of listing, as well as key challenges and concerns that we might be facing with regulators, if any.
Yeah, thanks, Marilyn. Thanks, Marvin, for your question. As ESR, we are a listed company in Hong Kong. You can see that we have actually applied for the PN15 application, which was actually approved by the Hong Kong Stock Exchange. And concurrently, we started our application with the NDRC, the CSRC, as well as the Shanghai Stock Exchange. For people who have actually noticed, the Chinese government published the Chapter 236, which actually made some of the rules clearer for us. As such, NDRC is taking a bit more time to review all the applications, which is actually positive. And we shouldn't forget that this REIT program continues to be called a pilot program. So the process is being refined along the way. We are likely to get our approvals by all the authorities, likely by end Q2 or beginning of Q3. So we are still targeting for this year, but a lot of the timetable is actually dependent on the government. Yeah, hope I've answered your question. Thanks, Marvin.
Thank you. Thank you to the Greater China team. Thank you.
Okay, thanks.
Thank you.